You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's dive straight in today. We're aiming for a fast, comprehensive look at the whole global landscape. Really cutting across those key pillars, FX, commodities, what's being said on trade, and those geopolitical flashpoints.
Right.
The mission here is just to distill what you need to know right now, because the main feeling is definitely, caution. It feels complex out there, especially G10 capital flows.
Yeah, that cautious tone is absolutely critical, and I think it really starts with the U.S. dollar.
Okay.
The immediate market tension, it stems from the reaction to Thursday, what everyone's calling the hawkish cut impulse.
Right. Let's just quickly unpack that for everyone. A hawkish cut, it sounds contradictory, but it's when the Fed lowers rates, which seems helpful.
Yeah, it gives some relief.
But at the same time, their forward guidance is tough. They're saying, okay, we cut, but maybe that's it for now, or rates will stay higher for longer than you thought.
Exactly. They cut, but they sound tough doing it. And that keeps the dollar, strong.
So the dollar's aggressive run paused a bit after that.
It did pause, yeah. But the overall defensive mood, that's still very much here, elevated.
And that caution makes sense, right? We're heading into a lot of U.S. data.
A major calendar of data, and crucially, a whole cascade of central bank speakers globally. So lots of potential news.
And this really highlights that central paradox we're seeing everywhere, doesn't it? The sort of balancing act between, fire and friendship feels like a good way to put it.
It really does. A strange mix.
On one hand, you've got this intense geopolitical friction, things that could cause massive disruption.
Huge potential fallout.
But then simultaneously, you see world leaders having these seemingly constructive talks, high-level stuff on trade, even defense.
Right, and the market's it's struggling. How do you even price that? The risk of catastrophe and the possibility of cooperation.
Yeah, it's a tough calculation. Is the cooperation real, or is it just trying to avoid the worst right now?
That's the billion-dollar question, isn't it?
Okay, so let's start where the volatility is maybe clearest, the currency crossroads. Even though the dollar rally eased off a bit,
it still has that pull.
Exactly. It holds the significant gravitational pull. We're seeing Euro ID still stuck below 1.1 seat.
And the key thing there isn't just the price level, I think. It's the sheer volume of defensive money flowing into U.S. short-term assets.
So that's what's anchoring it.
Yeah, it confirms that high-rate environment is expected to stick around for the long haul.
And that directly hits the riskier currencies, right?
Absolutely. High beta FX currencies, sensitive to global growth vibes, they're really struggling.
What's the main pain point there?
Well, the weaker than expected Chinese manufacturing PMIs didn't help. They slipped back into contraction territory.
Oof. So the Aussie, the Kiwi dollar, they feel that straight away.
Immediately.
Yeah.
If Chinese industrial demand looks shaky, that commodity-linked support just vanishes, kills any rally attempt.
But it's not all about the dollar, is it? You mentioned other factors.
No, exactly. While the Fed's dominant, what's fascinating is how domestic policy signals are creating this hypersensitivity elsewhere. It's like the G10 is splitting into different policy theaters.
Okay, so what stands out to you in that divergence?
Well, look at the yen. You can almost feel the distress from Japanese officials.
How so?
Sensitivity is sky high after the Tokyo CPI came in hot. Domestic inflation is building pressure.
Right.
So officials keep having to publicly talk about concerns over rapid currency moves. That constant chatter keeps the intervention watch alive. It's a major unique drag on the yen.
Okay, so yen is worried about inflation and intervention. What about elsewhere?
Then you flip to Switzerland. They're offering basically the inverse approach.
Really?
Yeah, the Swiss National Bank's signaled policy is, quote, appropriately accommodative. They're actually willing to tolerate inflation dipping below zero for a bit.
Wow, okay, so they're fine with a little deflation.
For a short spell, yeah. That managed expectation helps keep the franc as a safe haven, but under totally different conditions than the U.S. dollar.
Fascinating. And sterling, you mentioned that's different again.
And sterling is heavy, yeah, but for a completely different reason again. This isn't really about inflation forecasts or rate policy right now.
It's the politics.
Almost entirely driven by domestic political headlines. Big fiscal questions are back in focus, creating pure political risk that's just weighing the currency down.
So you've got yen driven by inflation fears, the Swiss franc by deflation tolerance, and sterling by political uncertainty. That really paints a complex G10 picture.
It's incredibly fragmented right now.
Okay, since this uneven policy is clearly hitting currencies, let's connect that uncertainty to the real economy, commodities, industrial output. What's happening there?
Well, base metals seem kind of stuck. They're in a range reflecting that global uncertainty we talked about.
Makes sense.
But the energy story is really focused squarely on crude oil. Prices are struggling to get any traction.
Ahead of the OPEC Plus meeting this weekend.
Exactly. That's the critical event. The key headline floating around from delegates is this idea of maybe 137,000 barrel per day supply increase.
137 kbpd. That sounds quite small, actually. Why is that number significant?
Symbolic, I think. It's keeping prices muted because the market can't tell. Is OPEC Plus signaling confidence in demand? Or does that small number suggest they're disagreeing internally? It hints at fragility in their consensus.
Interesting. Okay, so oil is waiting on OPEC plus Dow. What about precious metals? Gold?
Gold briefly dipped below USD 4,000 an ounce. Tested that level on the downside.
And that's the dollar effect again?
Yeah, again, it reflects that strong post-Fed dollar bid we discussed. Gold is just struggling against the sheer strength of the greenback right now.
But the real anchor for the industrial outlook, the hard data that seems to be coming out of China, specifically heavy industry.
That's right. The China Steel Association just flagged something pretty stark. A forecast fifth straight annual decline in apparent steel consumption for 2025.
Wow, a fifth consecutive year.
Yeah, a fifth. That's staggering. When you hear about a 5-year expected decline in steel use, that's not just a quarterly data point.
No, that sounds more fundamental.
It signals that the whole industrial playbook of the last decade, fueled by massive Chinese infrastructure growth, well, that's over.
So uneven industrial recovery is the key phrase then.
Definitely. And it suggests that long-term industrial investment outlooks globally will probably be capped by that Chinese ceiling.
That is a sobering thought. If the backbone of industrial output is set to shrink for 5 years, the foundation for global growth projections looks inherently weaker than maybe people assume.
It certainly raises questions.
Let's pivot now to trade rhetoric. This is where that contradiction, cooperation versus competition seems most vivid. Despite all the friction, the talk around U.S.-China trade still sounds broadly constructive.
It does, on the surface.
Yeah.
Washington emphasized positive momentum after the recent Trump-Xi summit.
But they're still investigating China's practices, right? Tariffs aren't off the table.
No, the official line confirms the USTR probe is ongoing. Tariffs are still a possibility. But they did point to some near-term progress on things like fentanyl cooperation.
Okay, functional cooperation, maybe.
Functional, if contained. That's a good way to put it. They even signaled that Russian oil was discussed between the leaders.
But let's be critical for a second. Is hitting milestones on fentanyl really a trade breakthrough? Or is it maybe, low-hanging political fruit to make headlines look better while the core issues don't change?
That's absolutely the right question to ask. Is it substance or spin?
Meanwhile, what's China saying?
Well, President Xi used the APEC platform to call for safeguarding multilateral trade, smoother supply chains, more stability.
A stability message.
Exactly. And China's trade negotiators specifically highlighted their alignment with global green standards, pointing to strong exports in things like solar panels and EVs as proof they're contributing positively.
So they're pushing the "we're a reliable partner" narrative.
Very much so.
Yet we get this stark counter-warning from the region. South Korea's president talking about the global order being at an inflection point.
Right, and saying trade uncertainty is deepening dramatically.
And his point was that this environment, where the big global institutions seem weaker, is exactly why governments are now scrambling to build these strategic economic partnerships, relying on specific allies for supply chains, not global norms.
It creates this sort of bifurcated world, doesn't it? Diplomatic smiles on the apex stage.
Yeah.
But frantic defensive partnership building behind the scenes.
That dynamic leads us right into the geopolitical flashpoints and how they're being managed or not managed. That constant tension dictating risk premiums. We still have several friction points globally that are maybe contained but definitely tense.
The Middle East is obviously a prime concern. We saw Palestinian outlets reporting Israeli raids near Khan Yunis.
And that immediately adds noise.
Immediately adds noise and uncertainty to what's already a very fragile ceasefire framework. That kind of local friction can destabilize global sentiment, energy flows instantly.
We also saw a reported failure in high-level diplomacy elsewhere.
Yeah, reports suggested the planned Trump-Putin meeting got canceled. Apparently, Moscow set preconditions that were described as maximalist.
Meaning non-negotiable demands.
Effectively, yeah.
Yeah.
Made dialogue impossible from the start. And separately, Washington signaled it had identified potential targets in Venezuela linked to drug trafficking. These things just add to the background stress the market has to absorb.
But here's the fascinating counterpoint again, strategic de-escalation.
Exactly. It's like these tensions, these failures even, are precisely what force the major powers to keep other critical communication lines open.
Like the defense talks.
Right. The U.S. Defense Secretary described his talks with his Chinese counterpart as constructive.
So there's the paradox in action. You've got maximalist demands here, fragile ceasefires there, while simultaneously making these focused efforts to manage the rivalry, avoid miscalculation, especially in a critical zone like the Indo-Pacific.
It's very much a strategy of managing rivalry, you're right. Not trying to dissolve it, just manage it.
Okay, so let's try to synthesize all this. What's the overall setup for today heading into next week?
Well, the market is definitely playing defense right now. The immediate outlook seems to favor a cautious, dollar-supportive stance.
Driven by that U.S. data calendar and the central bank speakers.
Exactly. You're sort of paid to own the dollar in the short term. Currencies like the yen and sterling, as we discussed, remain super sensitive to specific policy words. One wrong phrase could spark real volatility.
And commodities.
Over the next few days, commodities are going to be driven far more by those weekend OPEC plus headlines than by any fresh fundamental data, I suspect.
Okay, so here's the key thing for you, the listener, to track. While policy and data are the immediate drivers, what could really shift sentiment in FX and metals next week? Those are the swing factors.
Right, and they depend entirely on whether there's real substance behind all this constructive rhetoric we've been talking about.
What should people look for specifically?
Confirmation of tangible actions. Things like concrete tariff suspensions actually happening. Clarity on large commodity purchase flows. Is China really buying big again? And any official news on rare earths licensing pauses. Those kinds of details.
Because those details signal whether the cooperation is real or just talk.
Precisely. They tell us if the current efforts to manage rivalry are genuine collaboration or just temporary tactical moves to avoid a blowup. Until we get those tangible confirmations, the risk environment stays highly charged.
It really highlights the interconnectedness, doesn't it? Even seemingly small things, the final OPEC plus number, a local CPI print, can have massive ripple effects because the whole system feels so tightly wound right now.
It does. And it brings up, I think, the fundamental question for markets and for global strategy right now.
Which is?
Yeah. Given that policymakers are navigating these maximalist demands, this extreme friction, while also pursuing constructive dialogue on trade and defense, is the current global strategy one of genuine, forward-looking collaboration? Or is it really just a calculated, temporary effort to avoid immediate, catastrophic miscalculation?
That's the big question hanging over everything. Is this real change or just kicking the can down the road?
That's the answer everyone is trying to price in right now.
Yeah.
And it's not easy.
Keep exploring the implications of that dual strategy. We'll talk to you soon.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.